So with headlines screaming, markets falling, we thought it a perfect time to discuss why not all pullbacks are the same. So this week, we're gonna talk about why pullbacks are not all the same. And really what we're talking about is even in the midst of a general pullback, everything's working a little bit differently within the broader markets, whatever you might be looking at. So tough times come as investors, scary headlines, lots of doomsday type forecasts, market pulling back. Been in this business long enough to know 5% pullback feels and looks a lot like a 20% pullback to people, and they fear that, hey, this only more is on the way. It's that recency bias that any of us can get swept up in. To set the stage for this whole video, want to remind people, we put these commentaries out, we share these news data, we do our own, not to be predictive. That is not the goal. We don't want to get into a business of trying to time markets. It's really about two big things. Number one, perhaps most importantly, emotional preparation, not prediction. You think about a sunbather getting splashed with water versus someone jumping into a lake of the same temperature. Two very different experiences when you're expecting it. And so while we can't predict, we can look at an array of things that are probable and be better prepared for them. Whether they're going to be good, bad, or otherwise, we're ready and hopefully less likely to be reactive. Second is positioning. And I know this might strike people like timing a market. For me, timing is really when you're making a ridiculously overweighted call, you're getting all in or all out of a certain market or asset or even position. We're talking about positioning. So weighting and balancing, looking at potential risk rewards, we'll get into valuation in a minute, to know where we might want a little bit more, where we might want to pull back a little bit and bank some of those gains. And so it is with that we go into this video. Not all pullbacks are the same. And again, we'll talk about here to begin the importance of valuation, looking at three things: what it's not good for, and then how it does help, and really how it's played out here of late. So what it's not good for: timing markets. Cheap markets can get cheap. It was not an expensive market in 2007 before it plummeted down in 2008. Similarly, you have instances, say 2022, where things got to levels and then resumed their ascent to even more expensive valuations. And so it is not a timing tool. However, it is valuable for a few things. Number one is weighting between asset classes. Back in October of 18, we shared some different equity markets with different valuations, some that were more in the green category, historically attractive, some in the red, historically unattractive. And so it does help you understand, again, if you can be that patient investor, look with that 3, 5, 10-year type time frame. History would suggest that there is a strong correlation between buying something at a certain price and what I'm likely to get in the future, but rather what is to come, and that's where we want to be as investors. Second is pullbacks as opportunities. Here we'll put up yet the third chart. We've seen this over and over and over again because it is just one of our favorite charts and something we want to burn into the minds of clients and investors, which is again just the resiliency of the market. You can see 5% pullback, historically speaking, not even that big of a pullback. We don't know whether this is at the bottom or not. That's not the point here. The point is, even with an average intra-year decline of 14%, most markets recover to have positive, even calendar year returns, which is arbitrary, 75+% of the time. If you want more, you can go to 10capital.com, sign up for our newsletter. So much of the meat that is around these bones of these talks, again, in the written commentary. We don't want to bombard you here with a bunch. But we'll just take a look at, if you go back to look at that October 18th commentary, the growth parts of the market that we warned you about, 12.6, I believe was another commentary we did this, between some of those more growthy parts of the market, the tech parts of the market. You know what I'm talking about because these are the stocks that your friends have been talking about at the cocktail parties here not too long ago during Christmas, versus those parts that, again, are historically cheaper. Buying low, as we've told you time and time again, usually entails not being popular up front. Popularity, all the brags come later in time. But here we're talking about protection. But in this chart, you'll see that while the S&P is now negative year to date, it's a year-to-date chart for U.S. growth versus U.S. value, value is still positive. Why is that? If the market's going down, isn't everything within it going down? No. Just as the things that go up doesn't mean everything is going up. But it is a great example of, in the midst of volatility, certain asset classes will just hold up better, but then also how relative valuation can protect your downside, because again, you're already trading at a cheap enough valuation. We're seeing this play out in a lot of other areas, US stocks versus international, US stocks versus bonds or real estate here year to date. And again, it really is those things that are trading at relatively attractive valuations versus those things that are trading at relatively expensive valuations. It doesn't tell us what the next 6 months might do, but again, I think you're starting to get sneak peeks into maybe what the next 3 to 5 years could look like for broader asset classes. We'll end here because of the deluge of negative news with just a few quick bright spots. One is rates are finally coming down. As we share in the written commentary from our colleague Michael Shea pointed out, rates down below 7 for mortgage rates, applications up solidly, not only indicative then of hopefully some good news to come for the US housing markets, but really perhaps belying an unexpected strength within the US consumer. US services data in February actually rose. New order data, often a leading indicator, also rose. And now different than hard data, but more quantitative. This will be the last chart for this video. The CNN Fear and Greed Index, solidly in extreme fear. Usually, again, you want to fade the sentiment. When the crowd's going one way, we really start to look to go the other way. In closing, know your history. Understand the resilience of market. Understand the role of valuation and the impact of investor expectations on relative upside and downside. But again, use this to prepare, to position, but not to predict. As always, we're here to help. Thanks so much.